Have you ever wondered how much Bitcoin you should own? Is 1% of your net worth enough? Are you underexposed or taking on too much risk? This video will help you think clearly about that decision. No guesswork, no magic formulas, just logic-based arguments grounded in market cycles, your age, risk profile, and long-term vision. If you're tired of not knowing what to do with your money, if you feel like the financial system has you running in place, or if you're simply curious about how Bitcoin can fit into your strategy for financial freedom, this video is for you. We'll talk about retirement, price forecasts, allocation models, how your age impacts your choices, and why saving in Bitcoin might make more sense than investing in it. If you're asking yourself, how much Bitcoin should I own? That already reveals something important. Deep down, you understand that Bitcoin has value. People who think it's just internet money or some kind of scam don't even bother asking that question. Only those who sense there's something special there, something that can protect, multiply, or preserve value, wrestle with this dilemma. But the real question isn't how much can you make? It's how much of your purchasing power do you want to protect? This isn't about getting rich overnight. It's about not getting poorer over time, like what's happening to people who rely solely on the dollar or traditional savings. That question, how much should I own, comes from a place of self-preservation. Deep down, you're not trying to speculate. You're trying to escape. Escape inflation, manipulated interest rates, and the constant erosion of your money's value. And that's exactly where Bitcoin fits in. As a safe harbor outside a system that keeps making you run harder every year just to stay in the same place. Most people look at Bitcoin as an investment, but that's the wrong mindset. Bitcoin isn't an investment, it's savings. And once you understand that difference, it completely changes the way you relate to it. Investing is when you put your money into something expecting a return, accepting the risk of loss. It's buying stocks, starting a business, betting on an idea. Saving, on the other hand, is the opposite. It's about protecting what you've already earned, trying your best to preserve its value over time. And in that sense, Bitcoin plays a role that government-issued money hasn't fulfilled in decades. The dollar loses value. Anything controlled by governments and central banks is doomed to inflation, but Bitcoin isn't. With a limited supply and unchangeable mathematical rules, it's the first asset in history with a transparent and untouchable monetary policy. In other words, it's a place where you can store your effort from today, knowing it will still have value tomorrow. Bitcoin is above all a store of value. What makes that possible is its absolute scarcity. There will only ever be 21 million Bitcoins, never more. No government, central bank or authority can print more of it. That cap is built into the code and it cannot be changed. This is completely different from traditional currencies, which are constantly inflated. When they print money out of thin air, they're not creating wealth. They're just diluting the value of what you already own. It's like being robbed without anyone reaching into your pocket. That's why Satoshi Nakamoto wrote, "The root problem with conventional currency is all the trust that's required for it to work. With Bitcoin, you don't need to trust politicians, banks, or institutions. You trust math, open source code, and clear rules. And that alone makes it a superior store of value." Let's talk about retirement in a simple, practical way. There's a widely used calculation among those who follow the FIRE philosophy. Financial independence, retire early. Here's the logic. Multiply the amount you want to receive per month by 200. That gives you an estimate of the total wealth needed to live sustainably without having to work. For example, if you want $5,000 per month in income, you'd ideally need to accumulate about $1 million. That amount, invested safely, would allow you to withdraw monthly without depleting the principal too quickly. Now think with me, how much of that amount do you want to hold in Bitcoin? How much do you want to keep outside the traditional system, protected from inflation, monetary manipulation, and political instability? That's the question that changes everything. Because it's not just about how much to buy, it's about where you want to anchor your future freedom. How much Bitcoin you should own also depends on your age. Because time changes everything. An 18-year-old has a powerful advantage. Time to make mistakes and learn. They can take more risks, be aggressive, try different strategies. If things go wrong, they still have decades ahead to recover, rebuild, and adjust course. Now, for someone who's 80, the logic is different. At that stage of life, the main goal is preserving what's already been built. The focus isn't growing wealth at all costs, but rather protecting capital from irreversible losses, because the recovery window is much shorter or simply doesn't exist anymore. Bitcoin can be part of both portfolios, for the young person building the future and for the elder protecting it. The difference lies in the proportion. One can afford to be bold, the other needs to be more cautious. Understanding that is key to not turning a tool of freedom into a source of anxiety. When it comes to how much to allocate to Bitcoin, there are simple models that can help you make more informed decisions. One of the most common is the 1% rule. Even if you're extremely conservative, putting 1% of your net worth into Bitcoin gives you asymmetric exposure, meaning the most you can lose is 1%, but the potential long-term upside can be exponential. For those with higher risk tolerance, who understand the asset's potential and see Bitcoin as an ethical store of value against the state, it's not unusual to see allocations between 50% and 100% of their portfolio. There's also the barbell model, popularized by Nassim Taleb. You put a large portion of your money, 90%, into ultra-safe assets like cash or fixed income, and a smaller portion, 10%, into highly asymmetric assets like Bitcoin. And it's that very asymmetry that attracts people like Michael Saylor, who converted billions from MicroStrategy into Bitcoin, calling it the most secure monetary network ever created. For him, the real risk isn't buying Bitcoin, it's ignoring it. He's also publicly stated that he sees the price of a single BTC reaching $5 million in the long run. And he's not just pulling that number out of thin air. That projection is based on three powerful catalysts: the approval of spot Bitcoin ETFs, the adoption of fair value accounting for companies holding Bitcoin, and the accelerating pace of global institutional adoption. These factors are creating a new landscape. Companies, pension funds, governments, and large investors are beginning to treat Bitcoin as a strategic long-term asset, much like gold or government bonds. But with one major difference: Bitcoin is scarcer, more transparent, and more liquid. And here's the crucial point. If this vision becomes reality, even small fractions, like 0.01 BTC, could become extremely valuable. What seems like a small amount today might represent something huge tomorrow. It's not about owning a whole Bitcoin. It's about making sure you own a piece of something that could one day be out of reach for most people. Bitcoin moves in cycles, and the main marker of these cycles is the halving, an event that occurs roughly every 4 years and cuts in half the number of new Bitcoins issued. That means new supply shrinks while demand tends to grow. The result? Historically, halvings have been followed by strong bull markets, often followed by sharp corrections. Understanding where we are in the cycle is key to making smart decisions. Around the time of a halving or shortly after, history shows that price appreciation tends to accelerate. In periods of extreme euphoria, caution might be the best strategy. And during times of fear and disinterest, that might be the perfect moment to act with courage. The market is emotional. There are times when everyone wants to buy, and times when no one wants to hear about Bitcoin. But it's in those quiet, ignored moments that the greatest opportunities tend to appear. Knowing where you are in the cycle helps you decide how much to allocate and how to act with intelligence, not emotion. Unlike stocks, real estate, or bonds, Bitcoin doesn't rely on third parties to function. It's not subject to company management, banking crises, or government defaults. And unlike traditional retirement accounts or bonds, which are slowly eroded by inflation, Bitcoin preserves purchasing power over time, precisely because there's no uncontrolled creation of new units. If you think of retirement as a long-term plan, one that needs to withstand time, politics, and crises, it makes sense to consider an asset that doesn't deteriorate over the years. Bitcoin doesn't pay dividends or rent, but it offers something far more rare: sovereignty and real protection against the silent erosion of your wealth. Before deciding how much Bitcoin you should own, there's something that comes first: understanding what you're buying. Education before allocation. Because the biggest mistake people make is jumping in without knowing, hyped up by price spikes, and then panicking at the first drop. Those who understand the asset hold it with conviction. Those who just follow the crowd usually sell at the bottom, exactly when they should be staying calm. Bitcoin tests your patience, your long-term vision, and most of all, your understanding of what's at stake. That's why the best way to learn is by putting in a little and observing. This is called skin in the game. You feel it firsthand, you watch the market, and you study more carefully. Because in the end, a lot of people lose money with Bitcoin, not because the asset failed, but because they didn't know what they were doing from the start. They fell for scams, lost their keys, or just assumed it was quick and easy money. Before thinking about how much Bitcoin to own, think about how much you can generate. Because at the end of the day, the best investment is in yourself. Learning, growing professionally, developing skills, all of that increases your income and in turn, your ability to save. There's no point in trying to save a lot if you're still earning a little. That's why investing in knowledge, health, your network, and your productivity is worth more than any asset. Bitcoin can preserve value, but only you can create it. Financial freedom doesn't just come from how much you save. It comes from how much you can generate on your own. The more you can produce independently, the less you depend on others, and the easier it becomes to build real, lasting wealth. You don't need one whole Bitcoin to participate. What matters is understanding the value of each fraction, because in the future, even those could become out of reach. The truth is, there's a silent race for fractions happening right now, and most people haven't even noticed. Every second, someone somewhere is buying a little more. Time is ticking, and Bitcoin is being absorbed, sat by sat. At the end of the day, the real question isn't how much Bitcoin should I own? The right question is, what happens to me if I don't own any? Because the bigger risk isn't being exposed to Bitcoin. The real risk is ignoring a technology that's transforming the global financial system. While your money quietly loses value every single day, owning a little can protect you. Owning nothing could cost you everything.